So we start off the year with a disaster jobs report which leaves the Fed in a difficult position. Remember, the Fed are now happy that CPI is starting to show some improvement, but one of the key areas which they want to be focused on is seeing that labor start to weaken and soften. Yesterday, we got a reading which actually spelled the opposite. We had the JOLTS figure which came out, and not only was it much higher than expected, in other words, there are more job openings than expected, but also they revised the previous month's figure up as well. So where the Fed was slightly happy that October was a softening in the JOLTS figure, that was revised up. We also were worse than expected on the November reading as well. Let's take a look here at what we had. So it showed that the positions available were 10.46 million. The expected figure here by the consensus estimate was around 10 million. So 500,000 more openings than expected. More noteworthy, however, is the fact that the number of quits increased by 126,000. What does this mean? This means that labor participants are quite confident that they can quit their job and still get another job. In other words, the demand is so high for labor that they feel confident they can quit, go get a new job, and often when people quit to go get a new job, that's often accompanied with a pay rise, because when people are quitting, they're often not happy with their pay terms and they go and expect a pay rise. What does that mean? More inflation. Also, open positions outnumbered available workers by 1.7 to 1, okay? This is what Jerome Powell wants to soften. When we keep hearing him talk about CPI, we understand that he wants inflation to come down. When he's talking about labor, these are the things he wants to come down. If we take a look here at what we've got, you've now had a little bit of a decline, but not great. They were expecting this bar here to be in at 10 million. So again, this has kind of had a dip down here in August time, gone back up, and still remaining quite high here. So even though he's making these strong hikes in interest rates, it's not having an impact, and that could create a bit of pain for crypto, because what it now means is Jerome Powell may have to continue to remain hawkish, and we saw that yesterday in the FOMC minutes. Remember, these are minutes from the December meeting which we covered off, and if we look at the headlines for those who haven't had time to read it all, these are the key things I found. One, more rate hikes, right? They're going to continue to hike rates. The higher rates will last for longer. Remember, it's not just about how much they hike, but it's what is that terminal rate? Where do they get to? And then how long do they stay there for? None of the officials see a rate cut in 2023, so that's been wiped off the cards as well. Q4 GDP continues to run hot, which means the rate hikes aren't slamming the economy just yet, right? It's not taking enough of effect. PCE inflation, which is their preferred measure of inflation, is still hot, even though we're seeing the CPI easing, and the labor market is still tight, which we've covered off as well. So all these things to say that Jerome Powell and the Fed are in a little bit of a tricky position. If you take a look at the detailed minutes here, you can see that the measures indicate the expectations for the committee to maintain elevated policy rates throughout 2023. I just want to bring you to some of the highlights. Both the labor force participation rate and the employment to population ratio declined a little over the past 2 months. So this is the disaster bit, right? So in their FOMC minutes, when they were discussing this last month, they were happy. They're pointing out here in their notes that it was positive that the population ratio declined over the past 2 months. The private sector jobs opening rate, as measured by the JOLTS, moved back down in October but remained high. So since this meeting was revised up, we just got the revision up. So not only was it raised up for October, but the November figure was high as well. So that's a double whammy here for Jerome Powell and the Fed, because they're going to have to rethink this, because at this point, when they were writing these minutes, they thought that they had an improvement in some of those JOLTS figures, but that's been unwound now. So this is a little bit of a concern in terms of the Fed's policy. What does this mean in terms of what people are pricing in? Remember, we get the next FOMC meeting on the 1st of February, and you can see here, it's not really had an effect. 94% of the market, the vast majority of the market here, is expecting just a 25 base point rate hike. Now, I'm not sure where this is coming from. I personally think we're going to see 50 basis points. I think we saw the cut from 75 to 50. I think Jerome Powell will probably go in with another 50 basis point rate hike. But you're seeing that 94% of the market thinks he's just going to do 25, and 6% of the market even thinks he's going to pause a rate hike and do nothing and leave it at the current target rate of 4.25 to 4.5 on the Fed funds rate, which is interesting. The other thing to watch out for is we do have the non-farm payrolls coming out tomorrow. Now, it's very important with the non-farm payrolls that we understand what is it we're expecting. We, again, want to see that soften. So we're expecting 200,000 jobs. Anything averse, and the markets will not be happy because we've already had the bad jobs figure yesterday. If we get a bad non-farm payroll tomorrow as well, that could be a concern. We'll cover that off in tomorrow's video as well. Let's now jump straight into the charts, because the charts are giving us a few mixed messages. Because on the one hand, we're seeing crypto do okay, but on the other side, we know now that the Fed aren't in a mood to let markets get overly excited. And they even said that in their Fed minutes. They say that the unwarranted market rallies, in other words, are not, they're not acceptable. He doesn't want that to happen. And he wants to keep markets firmly in the hawkish position. So let's jump into the charts. If we take a look here at the Bitcoin chart, you can see here that the last few days or so here, from the 30th of December up to where we're at now, has been a pretty decent move. I mean, if we take the measured move from there up to about where we're at, it's a 3 to 4% move. And you've seen we're moving into our EMA ribbon. And we've seen that various altcoins have been moving alongside that as well. Now, if you look at it, it's a pretty decent pattern. You've created your low when FTX collapsed, and you've managed to create higher lows. So this is the formation of an uptrend. Now, obviously, we know we've got the resistance from the EMA ribbon. That's not going to be easy to beat, right? This is going to act like resistance, pushing us to the downside. The green candle volumes aren't huge. If you look at the volumes we were seeing here in the middle of December, we're less than that volume right now. So maybe some people are still coming back off holidays, but we're not getting that volume, which is giving us the confidence that we can flip our EMA ribbon bullishly. Now, another thing I want to share with you, and it starts off with the positive thing. And on the positive is on this weekly candle on the dollar index, we did get our weekly close below the weekly EMA ribbon. Now remember, this is very, very important. We've not had this for a while, and what we wanted was a nice weekly downtrend signaling a big move to the downside. If I zoom out here so you guys can see that, this is what we want to see on the dollar index. A flip to the downside and hopefully a nice big move to the downside. But we've got to keep an eye out that this is not just a trap. And the reason I say that is if you look at what we've got here, this could very easily be a very strong week for the dollar index, bouncing us back into the EMA ribbon and giving us a move like this. So I do not want to get caught up on this. In order to feel confident, I want another red weekly, and I want to see the dollar index really start to show weakness here on the weekly chart, because this, coupled with what we're seeing from the Fed, may bring that risk-off mindset back to markets, which would see a big bounce here and therefore a decline in Bitcoin. Remember, this move's inversely correlated to Bitcoin. So that's definitely something I'm watching out for. What am I currently doing in the market? Well, for me right now, I'm still focused on accumulation mode, but mainly on the big projects, mainly focused on eating my vegetables, and that is Bitcoin and Ethereum. We had a chat with our course member live streams where I showed how I make my plan for the year ahead. If you guys want to become a member, ijaz.uk/member, you can join our 3 times weekly live streams. And I just went through and said, this is my plan for the year. This is what I'm trying to do. This is how I'm going to break it down. This is my architecture. And that's what I'm focused on right now. I want to think about, by the time this gets to December 2023, what do I want my portfolio to look like? Because ultimately, that's the single metric I can control. I cannot control whether it's a risk-on environment or risk-off environment. I cannot control what Jerome Powell or the Fed decide to do or not do throughout this year. One thing I can control is say, how many Bitcoin do I want to own by the end of this year? How many Ethereum do I want to own? What other projects do I want to own? And in what percentages of my portfolio? That's one thing I can control going into and waiting for the next bull run. And the reality is, we've got people in the market right now who are so fearful, and yet these very people will be buying Bitcoin at the peak at 64,000, 65,000. And ultimately, it comes to one thing, and that is that they have green candle disease. And whether people want to accept it or not, this is a real problem in the crypto space. And I've named it green candle disease because people buy a crypto and they need charts to give them conviction. They need the charts to print these green candles to tell them, hey, great job buying that altcoin. Hey, great job buying Bitcoin. Here's a couple of green candles. Whereas the psychology of any investments, whether it's traditional finance, whether it's stocks, whether it's real estate, is to not worry about those price movements. It's to say, what are the fundamentals of the thing I'm buying? Why am I buying Bitcoin? Do I believe in the narrative? Do I believe in the computing power? Do I believe in the scarcity and the fact that you cannot mute the network and it's permissionless? Or am I just buying it because I want green candles the day after I buy? And when you can suddenly start to decipher that and buy when markets are fearful, then you can start to panic now. Because now is when you want to be panicking to go and find cash to invest in crypto. Because if you're not, when are you going to? if you're unable to buy here at these levels, which a lot of people are feeling like is the bottom, I mean, one thing I can say for sure is we're closer to a bottom than we are a top, right? In terms of where we could be with crypto. If you're not panicking now to figure it out, what are you going to be doing? Are you going to be one of those who panics at the peak of a bull run when Bitcoin's back at 90,000, 100,000 and panicking to get every single penny to buy 0.1 of a Bitcoin? Or could you do that now when others aren't interested, when people are not talking about crypto, when your taxi driver, your Uber driver is not talking about crypto, when your local restaurant waiter is not talking about crypto, your colleagues are not talking about crypto? Is now not that time you want to be doing it? So I play devil's advocate. I want you to steelman that argument and think about what is your psychology leading you to do? Do you have green candlesticks? Because we can all get caught up in that. We can all get caught up in wanting the charts to tell us that we made a good decision, but charts don't tell you if you've made a good decision, right? It's a lag measure. What tells you if you made a good decision is, are the projects you've invested in solid? Are they sound? Do they have good tokenomics? Do they have a good founding team? Do they have a good mission statement? Are they building? Are they making progress? These are all the things that fundamentally matter. The Fed continued to be in a bit of a bubble. They thought they were seeing some progress with the jobs figures, but that's been unwound yesterday with the latest job openings. The FOMC meetings were quite insightful in that, look, they want to continue to be hawkish. They want to put their foot firmly on the neck of the markets. And that means if those of you are excited that we're going to see these big rallies in a completely different 2023, my reality was that Q1 and Q2 are more of the same from 2022. Whether we earn the right to have a better Q3 and Q4 later this year, that's yet to be seen. But we're still in a continuation of last year, and nothing from a fundamental perspective has completely flip-flopped yet. I hope you guys enjoyed this video. If you appreciate this type of content, smash the likes. Don't forget to subscribe. Ijaz.uk/TA for a free TA course. Go take advantage of that head and shoulders pattern, EMA ribbon, Bollinger Bands, all that stuff completely free. Not charging you a penny. Links in description. Ijaz.uk/TA. Thanks for watching, guys, and I'll see you in the next one.